Most LLC owners don't realize that they have options when it comes to taxes. What if I told you that your tax selection you choose for your LLC could make or break your bottom line? Today, we're going to talk about the 4 different ways an LLC can be taxed. My name's Anthony Brister, and this is a wealth planning podcast. So, like I said, today we're going to talk about the 4 different ways an LLC can be taxed. The first 2 are default, and then the last 2 are elections that you have to make with the IRS. So, first one is for single members. So, if you have one owner of the LLC, this is going to be your default, and this is the sole prop or disregarded entity. So, when you have one owner of the LLC, typically this is going to show up on your Schedule C if you are an active business, or Schedule E if you've got a rental property. Our second option on how an LLC can be taxed is if you've got 2 or more owners. Well, the default there is a partnership. Again, very simply, if you've got more than one owner, you're in an LLC, you don't make a tax election, you're going to be taxed as a partnership. So these first 2 entities, the sole prop and the partnership, are good for passive activity. So rental properties, if you're passively investing, these are good for the asset protection component that you have. But for active businesses, the downfall there is you're going to be paying self-employment tax, which is 15.3% on all of your earnings up to a certain point. So for those active business owners, once you make over a certain amount, check out my S-Corp video for that information. But once you make over a certain amount, you might want to actually think about making one of these next 2 elections. So the third option and most common option for active business owners is an S-Corp election. So with this election, you do have to file paperwork with the IRS to make the S-Corp election. This is very good for those active businesses because it allows you to avoid some of the self-employment tax on your active income. You have to pay yourself a reasonable salary. There's typically a little bit more work that comes along and formalities with the S corporation. You have to file another tax return. But again, if you're making over a certain amount, the S Corp election is a really powerful tool. And the last of the 4 ways that an LLC can be taxed is a C corporation. C corporations aren't very common for small business owners. There's a lot of bad advice out there going around telling people to operate out of a C Corp. Problem with C corporations are, first, you have double taxation. Really, typically, the only way to get money out is by being double taxed or by taking a salary, which makes you pay the full self-employment tax anyways. So C Corps aren't really good tools for small business owners. Now, they do work in some cases, specifically for medical reimbursement plans, or if you plan on selling your company on down the road, a C corporation can be a very good tool. So just to summarize, today we talked about the 4 different ways an LLC can be taxed. The first option is sole proprietor, and that's the default if you have one owner. Second option is partnership. That's also the default if you have 2 or more owners. Third is S corporation. This is what most business owners should be using if they're making over a certain amount for active businesses. And then the C Corp, which we want to stay away. This was the Wealth Planning Podcast with Brister Law. Hope you guys enjoyed it. Please like, subscribe, comment. If you have any questions, please comment, let us know. As always, if you want to schedule a discovery call, go to www.bristertaxlaw.com. You can schedule a free discovery call today.